For more than a century, Warner Brothers was one of the pillars of Hollywood, a studio whose logo alone carried the weight of global recognition. A place where billion-dollar franchises were born, where generations of filmmakers built careers, and where some of the most enduring stories in modern entertainment took shape. So when the news broke in 2025 that Warner Brothers, this 100-year cultural institution, was being sold in a deal valued at roughly $72 billion, the industry froze. Not because studios never change hands, but because Warner Brothers wasn't supposed to be the one at risk. Not this brand, not this legacy. The sale wasn't an isolated event. It was the final chapter of a long, complicated decline. Rising debt, fragmented leadership, failed integrations, and a streaming strategy that never aligned with the market or the creative community. For years, the warning signs were there in quarterly filings, in talent disputes, in shrinking leverage across the industry. But each signal was treated as a temporary setback instead of a structural problem. By 2025, the truth could no longer be buried inside balance sheets and press releases. Warner Brothers had reached a point where selling the studio was no longer a strategic option. It was a necessity. To understand why the fall of Warner Brothers was so shocking, we need to understand what the studio once represented. Founded in 1923 by four brothers with limited capital, but an unusually aggressive appetite for innovation, Warner Brothers entered Hollywood during an era dominated by larger, better-funded competitors. Yet within a decade, the studio had already changed the industry. It was one of the first to fully commit to sound filmmaking. The success of The Jazz Singer positioned Warner Brothers as a studio willing to take risks others avoided. Through the mid-20th century, Warner Brothers became a consistent producer of cultural landmarks. Whether it was Casablanca, Looney Tunes, or later The Exorcist, the studio built a reputation not only for hit films but for content that defined eras. By the early 2000s, that legacy expanded into global franchises. The Harry Potter film series generated over $7.7 billion in worldwide box office revenue, while the Dark Knight trilogy reshaped the modern superhero genre. With properties like DC, Middle-earth, and The Matrix, Warner Brothers controlled some of the most valuable IP in entertainment. Financially, the company stood as a stable giant. Even during recessions and industry disruptions, Warner Brothers remained one of the few studios capable of delivering billion-dollar years off the strength of its library, licensing deals, and theatrical pipeline. Its catalog became a major asset for cable networks, pay TV outputs, and later streaming. More importantly, Warner Brothers symbolized something rare in Hollywood: institutional continuity. Other studios rose and fell. Strategies changed, genres shifted, technology evolved, but for nearly a century, Warner Brothers stayed relevant by adapting faster, partnering smarter, and investing in long-term franchises instead of trends. That stability is what makes the eventual decline so difficult to reconcile. This was not a studio built on hype or temporary success. It was a studio built on history, discipline, scale, which is why the cracks that followed would prove far more damaging than anyone expected. The decline of Warner Brothers did not begin with the 2025 sale announcement. It began years earlier, through a series of structural decisions that slowly weakened the studio's financial stability, creative leverage, and long-term competitiveness. And while each decision appeared rational at the moment it was made, the combined effect was catastrophic. The first major turning point came in 2018, when AT&T acquired Time Warner in a deal valued at roughly $85 billion. The acquisition added enormous debt to the parent company, and from the start, it forced Warner Brothers into an operating model designed around telecom priorities rather than entertainment fundamentals. Under AT&T, the focus shifted towards synergies, rapid integration, and cost compression, leaving less room for long-term creative strategy. Projects were evaluated through the lens of subscriber acquisition rather than storytelling or franchise stewardship. The second mistake emerged in the race to build a competitive streaming platform. HBO Max launched in 2020 with strong content but unclear positioning. The service struggled to differentiate itself from existing HBO offerings, and the company spent heavily to scale it while simultaneously reorganizing its theatrical, licensing, and cable distribution models. The most controversial decision came in December 2020, when Warner Brothers announced that its entire 2021 theatrical slate would debut on streaming and in theaters simultaneously. The move was intended to support HBO Max growth, but it damaged relationships with filmmakers, talent agencies, and theater chains. Analysts estimated the studio forfeited hundreds of millions in back-end participation and box office potential due to talent renegotiations and reduced theatrical performance. The third and ultimately decisive mistake was the 2022 merger with Discovery, creating Warner Brothers Discovery with more than $50 billion in debt. The merged company faced declining cable revenues, significant restructuring costs, and heavy write-downs tied to content amortization. Under mounting pressure to deliver immediate cash flow improvements, leadership began canceling projects, delaying productions, and reducing investments in mid-budget films, all of which eroded the studio's long-term creative pipeline. Individually, none of these decisions guaranteed collapse. Together, they set Warner Brothers on a path where financial strain dictated strategy, where creative relationships weakened, and where the brand's century-old stability slowly gave way to volatility. And by the time the market recognized the scale of the problem, the trajectory had already become irreversible. The reaction to Warner Brothers' strategic decisions was immediate and unusually unified. Few studios in Hollywood could generate industry-wide pushback, but Warner Brothers' moves between 2020 and 2022 triggered a level of backlash that exposed just how quickly the company's goodwill had eroded. The strongest wave came after the studio's December 2020 announcement to release its entire 2021 slate day-on-date on HBO Max. Within hours, directors and producers publicly condemned the decision. Christopher Nolan, whose films had generated more than $4.9 billion in global box office revenue for the studio, called HBO Max the worst streaming service, criticizing the lack of consultation with filmmakers. Legendary Entertainment, co-financier of major titles like Dune and Godzilla vs. Kong, reportedly explored legal options after learning of the news through the media rather than through the studio itself. Talent agencies argued the move violated standard compensation structures tied to theatrical performance. Theaters reacted just as strongly. AMC and Cinemark issued statements warning that simultaneous releases would depress box office revenue during an already fragile period. Analysts estimated that hybrid releases reduced theatrical earnings for certain titles by 15 to 30%, depending on genre and demographic. For a studio heavily reliant on franchise economics, this represented a long-term threat rather than a one-year anomaly. The 2022 merger with Discovery triggered a second wave of backlash, this time internal. As Warner Brothers Discovery implemented aggressive cost-cutting measures, dozens of projects were canceled or removed from streaming, including completed titles like Batgirl. Writers, directors, showrunners expressed frustration over what they saw as unpredictable leadership and a lack of strategic consistency. Industry guilds questioned whether the company's debt-driven restructuring was prioritizing financial optics over creative stability. Investor confidence also weakened. Following the merger, Warner Brothers Discovery's stock price fell more than 35% in the first 6 months, signaling that markets viewed the company's long-term strategy with skepticism. By 2023, the message was clear. Warner Brothers had lost the trust of its most important stakeholders, creators, partners, and investors. And once trust is damaged, rebuilding it becomes exponentially harder. If the backlash revealed the emotional shift around Warner Brothers, the numbers revealed the structural one. By the mid-2020s, the data painted a far more severe picture than any public statement suggested. The first warning sign appeared in the balance sheet. When AT&T completed its acquisition of Time Warner in 2018, the combined company carried over $170 billion in total debt. Warner Brothers itself was not responsible for all of it, but the studio became part of an ecosystem where debt servicing took priority over long-term investment. Capital that once went toward film development, talent deals, and franchise expansion was redirected toward cost controls and repayment obligations. The second major signal came after the 2022 creation of Warner Brothers Discovery. The newly merged company began with more than $50 billion of its own debt. While also facing a rapid decline in traditional cable revenue, historically one of its most reliable cash-generating engines. Management responded with aggressive write-downs, totaling billions of dollars, tied to content amortization and canceled projects. These write-downs improved short-term accounting results, but highlighted deep structural inefficiencies. Revenue also shifted in concerning ways. While Warner Brothers continued to generate strong box office results for select franchises, the broader output failed to match pre-2020 performance. Streaming revenue grew, but not at the pace needed to offset losses from theatrical volatility and declining licensing deals. Analysts noted that HBO Max was spending at a scale comparable to major competitors, but without subscriber growth sufficient to justify the investment. Market confidence declined accordingly. In the months following the merger, Warner Bros. Discovery's market capitalization fell by more than $20 billion, reflecting investor doubts about the company's strategy and financial stability. By the time the $72 billion sale valuation appeared in 2025, it was no longer a surprise. The numbers had been telling the story for years. Understanding the fall of Warner Bros. Requires more than tracking individual missteps. It demands examining the underlying structural forces that gradually reshaped the company's incentives, reduced its creative leverage, and pushed it into a position where selling the studio became the least damaging option. At the core of this decline were four interconnected causes: debt pressure, strategic inconsistency, the economics of streaming, and the collapse of legacy revenue. Debt reshaped every incentive. The 2018 AT&T acquisition and the 2022 Warner Bros. Discovery merger placed the studio inside organizations carrying a combined debt load exceeding $200 billion across both transactions. Even though Warner Bros. Was not directly responsible for the full amount, the studio operated within a financial structure where cash flow preservation outranked creative investment. Film slates were adjusted. Mid-budget projects once essential to the studio's identity were deprioritized. Decision-making tilted toward short-term efficiency metrics instead of long-term franchise development. Debt did not simply restrict spending. It redefined the studio's strategic priorities. Strategic inconsistency across ownership cycles. Warner Bros. Experienced three major ownership shifts in less than a decade time: Warner, AT&T, and Discovery. Each leadership group introduced new objectives, new reporting structures, and new performance indicators. Under AT&T, streaming adoption and bundling were prioritized. Under Discovery, cash flow and cost restructuring became the focus. Frequent reorganizations created operational fatigue, while mid-level and senior executives struggled to align long-term plans with shifting corporate directives. Talent partnerships deteriorated as creators questioned whether the studio could offer stability in an industry where consistency is crucial. The economics of streaming never balanced. The launch of HBO Max was both ambitious and costly. The platform required multi-billion-dollar content investments at a time when subscriber growth across the industry was slowing. Unlike Netflix, which built its model around global scale, or Disney, which leveraged massive family IP, HBO Max occupied an expensive middle position: premium content with premium costs, but without premium subscriber volume. Meanwhile, the 2021 on-date release strategy weakened theatrical performance, reduced licensing opportunities, and complicated profit participation. The platform grew, but never at a pace that could justify the underlying cost structure. The decline of legacy revenue accelerated the slide. Historically, Warner Bros. Benefited from the stability of cable networks like HBO, TNT, and TBS. But between 2015 and 2023, U.S. cable households fell by more than 30%, eroding billions in high-margin revenue. Advertising declines and affiliate fee pressure created additional strain. Streaming was supposed to replace these losses, but its economics were less healthy and far more competitive. These causes did not operate in isolation. They interacted, amplifying risk, narrowing strategic flexibility, and leaving leadership with fewer viable paths forward. By the time the studio confronted its most critical decisions, the structural damage was already entrenched. Leadership at Warner Bros. Faced increasing pressure as the structural issues became impossible to ignore. The instability created by ownership transitions meant that senior executives were constantly adapting to new priorities, new cost directives, and new reporting frameworks. This volatility weakened long-term planning, but it also placed individual leaders under intense scrutiny when results failed to meet expectations. By late 2022, internal documents and industry reports highlighted a growing disconnect between Warner Bros. Discovery's strategic targets and the operational realities inside the studio. Leadership teams were tasked with reducing expenses while simultaneously rebuilding trust with filmmakers and accelerating the performance of HBO. These objectives were inherently contradictory. As budgets tightened, creative departments struggled to secure commitments for mid-budget projects, while executives faced criticism for canceling or shelving films that had already consumed substantial production costs. The pressure reached the top. David Zaslav, CEO of Warner Bros. Discovery, became a central figure in public debates about the company's direction. While he argued that aggressive restructuring was necessary to stabilize finances, analysts and guilds questioned whether the cuts were eroding the studio's long-term value. Investor calls grew increasingly tense as revenue projections repeatedly shifted and cost savings targets expanded. Inside the company, morale declined. Multiple waves of layoffs affected marketing, animation, scripted programming, and back-office functions. Senior leaders departed or were reassigned as divisions were consolidated and decision-making centralized. The cumulative effect was clear. Leadership was no longer steering growth. It was managing crisis, reacting to structural problems rather than shaping the future of a once stable studio. The Warner Bros. Case offers a set of lessons that extend far beyond the entertainment industry. At its core, the studio's decline illustrates what happens when long-term strategy loses ground to short-term financial pressure. Debt is not inherently destructive, but when it becomes the central force shaping decisions, it shifts the organization's priorities away from innovation and toward survival. Warner Bros. Spent years reacting to financial obligations created outside the studio's core business, and that pressure diluted the very strengths that once defined its leadership in Hollywood. A second lesson is the cost of strategic inconsistency. Frequent changes in ownership created competing visions, fragmented execution, and a lack of continuity across creative and operational pipelines. Companies that rely on trust, whether from customers, creators, or partners, cannot afford to reinvent their strategic direction every few years. Stability is a competitive advantage, and Warner Bros. Lost it. The third lesson concerns the streaming era. Growth in digital markets does not guarantee profitability, and pursuing scale without a viable economic model can accelerate decline. HBO Max had strong content and brand equity, but its financial structure was not built to support the level of investment required to compete with Netflix or Disney. Execution mattered as much as content. Finally, the case underscores a simple but powerful principle. Relationships are assets. Once filmmakers, talent agencies, investors, and employees begin to lose confidence, rebuilding that trust becomes exponentially harder. These lessons are not unique to entertainment. They apply to any company navigating disruption, debt pressure, and shifting consumer behavior. The story of Warner Bros. Is not just a corporate setback. It is a reminder that even the most iconic institutions can falter when strategy, execution, and financial discipline fall out of alignment. And as the industry continues its rapid transformation, the consequences of these decisions will shape Hollywood for years to come. If you found this breakdown insightful, consider subscribing. We explore major business failures and pivotal corporate moments, just like this one. But now, I want to hear your view. Do you think the sale will give Warner Bros. A chance to rebuild its legacy? Or is this the final chapter of a century-old studio?